Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video we're going to take a look at 3 undervalued healthcare dividend stocks that you can consider to buy or watch in the stock market right now. The first company to review is a company no other than BristolMyers Squibb. The ticker symbol BMY, traded on New York Stock Exchange. This company discovers, develops, licenses, and manufactures and markets biopharmaceutical products worldwide, and the company offers products in hematology, oncology, cardiovascular, and immunology therapeutics. The company was founded in 1887 and is headquartered in New York City. As you notice, the company currently has a dividend safety score of 79, which is considered to be safe according to Simply Safe Dividends. The dividend yield for the company is currently sitting at 2.88%, and the company has a market capitalization of $151 billion. When it comes to the volatility of the stock, it has a beta of 0.61. As for beta, a beta of under 1 suggests that the stock price is less volatile than the overall broader market. BristolMyers was last traded for the price of $68.12 at the time of making this video. Looking at the company's dividend history, the company has been paying dividend uninterrupted for the past 30 years, and over the past 14 years, it has continuously and consecutively increased its dividend amounts. The company pays a quarterly dividend in the months of February, May, August, and November, and its annual payout dividend at this time is at $1.96 per share. In terms of the valuation, BristolMyers' current dividend yield of 2.88% is about in line with its 5-year average of 2.93%, suggesting that the stock may be reasonably valued today. However, it's worth mentioning that BristolMyers' forward price to earnings ratio that you can see here, showing 8.5, is well below its own 5-year average of 12.2 for BristolMyers and the healthcare sector average of 19.8. Now, this could be a point for consideration. In these cases, and especially the scenarios where we have an unusually low price to earnings ratio, it could indicate that BristolMyers earnings could be near a cyclical peak, or that investors believe that the firm's long-term prospects for growth have weakened. So keep in mind that a very low price to earnings ratio is not necessarily always a good sign, though at times it could really be a sign of a great bargain, but you have to make sure to do your own due diligence. And we've done that. We've tried to do some additional analysis in the slides ahead, so stay tuned for that. But looking at the 52-week price for BristolMyers, the current price is much closer to the 52-week high price of $69.31. The 52-week 1-year low price for the stock was at $57.74. Moving on, we wanted to also take a look at the past 5-year stock price trend for BristolMyers. We also want to take a look at the total sales over the span of the past 10 years, as well as the outstanding shares over the span of the past 10 years. When it comes to outstanding shares, ideally we would like to see the number of shares shrinking. That's obviously a better sign for us. Nonetheless, in this case, we see for BristolMyers, they have recently issued some shares, and in 2020 as well as the past 12 months, we are showing that the number of shares has gone up compared to 2019 and 2018 and before that. As for total sales, the company's total sales, you notice that towards 2020 as well as 2019 had some considerable jump, and the last 12 months is also showing to be $44.4 billion in terms of total sales or revenue, which is quite remarkable and nice to see. As for the 5-year return for the stock price, is showing the overall 5-year return of 12.35%. This does not take into account the dividend payments. It's purely based on the stock price and the closing price for the stock. And we wanted to take a look at the price prediction by analysts for BristolMyers. According to TipRanks and the 6 analysts covering the stock, there are 4 ratings of buy, 2 rating of hold, and 0 sell. The analyst price target, 1-year price target for BristolMyers is at $73.50. That's the average analyst price target, which shows an upside of 7.90%, with the range of these price prediction being as high as $78 and as well as low as $71. Next, the second company to review is Sanofi, which is a healthcare company engaging in research, development, manufacturing, and marketing of therapeutic solutions in the US, Europe, and internationally. The company was formerly known as Sanofi Aventis and changed its name to Sanofi in May 2011. Sanofi was incorporated in 1994 and is headquartered in Paris, France. Sanofi has a dividend safety score of 90, which is considered to be very safe. It has a dividend yield of 2.69% at this time, and the company has a market capitalization of 127 billion US dollars. As for the volatility metric, the beta indicator, it is showing a quite low indicator here, with the ratio being at only 0.50, suggesting that the stock price for Sanofi is less volatile than the overall stock market. The last trading price for Sanofi at the time of making this video was at $50.85 USD. Moving on, if you look at the dividend history for Sanofi, you notice the company has been paying uninterrupted dividend for the past 21 years, and in all of those 21 years, they have consecutively increased their dividend payments. They are currently paying an annual dividend amount of $1.37 per share, and the company pays an annual dividend, and it is paid in the month of May. Unlike BristolMyers or many other companies that may pay their dividends on a quarterly basis, Sanofi does pay an annual dividend. Moving on, looking at the company's valuation, Sanofi's current dividend yield of 2.69% is about in line with their 5-year average of 2.76% dividend. This suggests that the stock may be reasonably valued today. Also, their forward price to earnings ratio of 12.4 is about in line with their 5-year average of 13.1. The market appears to be valuing the stock similarly to how it has in the past, suggesting that Sanofi could be fairly priced if you believe in the health and long-term prospects of the company being solid. When we compare their forward price to earnings ratio to that of the healthcare sector, which is at 19.8, we have a much more favorable number and ratio here. In terms of the past 1 year price volatility for the stock, the lowest price for the stock has been at $45.30, and the highest price that the stock has hit over the past 1 year has been at $54.25. Looking at the company's outstanding shares over the past 10 years, you'd notice that they have gradually decreased the number of shares, which is definitely something positive for us, and we would like to see that. That's a good sign. In terms of their total sales, for the most part, the company has gradually increased their sales. Of course, back in 2011 and 2012, their sales was at $36 billion, and afterwards, for several years, they actually were below that mark. But back in 2019, they started reaching 37 billion points in terms of sales, and even the last 12 months is showing $37.5 billion in sales. As for the stock price and their trend over the past 5 years, the company stock is showing an overall return of 26.6% over the span of the past 5 years. As for company's stock price target, there was only one analyst on TipRanks covering the stock, and they had an insane price target rating of $124.69, which seemed too good to be true. So we've looked at Yahoo Finance as well and taken a look at what is the price targets for the stock there. The price target on Yahoo Finance is at $65 per share, which again, if it remains true, shows a very, very decent upside potential for the company Sanofi at this time. All right, the third and final company and dividend-paying healthcare stock to review in this video is a company called Cardinal Health with ticker symbol CAH, traded on New York Stock Exchange. The company has a dividend yield of 3.85% and has a dividend safety score of 74, considered to be safe. The company has a market capitalization of 14.8 billion US dollars, and the stock has a beta or volatility score of 0.77. Again, just as a reminder, a beta score of under 1 suggests that the stock price is less volatile than the overall stock market. Cardinal Health operates as an integrated healthcare service and offers their products and services in the United States and internationally. It provides customized solutions for hospitals, healthcare systems, pharmacies, ambulatory surgery centers, clinical laboratories, and physician offices. The company operates through two segments, pharmaceutical and medical, and it was founded in 1979 and is headquartered in Dublin, Ohio. The last trading price for Cardinal Health was at $50.99. Looking at the company's dividend history for the stock, they have been paying their dividend uninterrupted for the past 37 years, and in all those years, they have consecutively increased their dividend. This company pays their dividend on a quarterly basis, and they have currently an annual payout of $1.96 per share. In terms of valuation, Cardinal Health's stock's current dividend yield of 3.85% is 10% above its 5-year average of 3.51%, which indicates that the stock may be undervalued unless you believe that the company's outlook has weakened. It is worth noticing that Cardinal Health's forward price to earnings ratio of 8.5 is well below its 5-year average of 10.5 and the healthcare sector average of 19.8. An unusually low price to earnings ratio could mean that investors may have become pessimistic about the company's prospects for growth, but if you believe in their company's health and long-term outlook being still solid, the stock could be really attractively priced. Looking at the number of outstanding shares for the company, definitely they have bought back their shares. The number of outstanding shares is continuously declining. The last 12 months, they have 294 million shares outstanding. Their company's total sales is showing to be consistently increasing since 2014, and the last 12 months they're showing a total sales of 162 billion US dollars. As for their stock price return over the past 5 years, the story is not as positive. They are showing a negative 39% return. It's definitely a major decline for the stock price over the past 5 years. Nonetheless, keep in mind that they are solid dividend paying company and has been paying their dividend consistently for decades. Lastly, looking at tip ranks and the stock prediction in terms of the stock price for 1 year, the average price target for the stock based on 6 ratings is at $57.50. That shows an upside of 12.77%. There is 1 buy rating, 4 hold rating, and 1 sell rating for the stock, overall showing a hold rating according to tip ranks, with the lowest price target being at $50 and the highest price target being at $68 for this stock. There you have it, folks, a quick look at 3 undervalued healthcare dividend stocks with safe or very safe dividend payments that you could consider to watch or add to your portfolio at this time. Please note that this video is based on our research and is for the entertainment purposes. Be sure to do your own research before buying any of these stocks or any other stocks discussed here on our channel, or for this matter here on YouTube. I hope you found this video beneficial and you gained something of value from it. If you did, please be sure to give this video a thumbs up and don't forget to subscribe to Momentum channel. Here on Momentum Finance, we post every week several videos about investing, including investing in the stock market, real estate, and crypto, as well as looking into ways to reach financial freedom. Thank you, and we hope to see you next time.